I don't want to answer your question about the recession.
S&P 100 on a tear up 0.8% as well.
EOS is a train wreck right now. It had its earnings release and then the management conference call, and it dropped 25% on that. And then this morning it dropped another 15%. In the Twitter sphere, the sky is falling and buildings are burning. It's a mess. I think two or more of the notable, actually I think more notable proponents of the stock previously have said they're selling or have sold all their shares, presumably at a loss, maybe not overall, but certainly a loss of value, 50 to 75% versus where they were a month or two ago, right? So, yeah, it's a mess. I won't dig into this too deeply here, as this is just intended to be a very brief update of where the portfolio stands after a couple ugly days. We've had, two good down days, I should say. Currently, the Russell is down, 1.2, 1.3%, so certainly weighing on our holdings. And then we had, of course, EOS and Confluent in particular being hammered. So we have, bad market and a couple of really bad equities. That being said, we have a lot that are up a lot as well. So I'll actually do a separate video on that. But I think it's worth, digging into the two that they're down as much as they are, because I think it's, the red's almost more important to study than the green, if that makes sense. Yeah, so at a high level, the issue with EOS is a question around bridge financing. They're a company already carrying a fair bit of debt. They have conditional loan approval from the Department of Energy. It's a loan for $400 million, and importantly, now they have a term sheet associated with that, giving them greater clarity around what needs to be accomplished in order to receive the money. So the money itself is earmarked for the capital costs associated with their automated battery unit production lines. The question is now, what's the burn rate between now and then, and how much money does EOS have to put up themselves before receiving 80% of the cost reimbursement as a loan from the DOE? So, they only have to put up 80% of the actual cost, but in order to get that 80% reimbursement, they do have to spend a certain amount of money, and it's sort of rolling throughout. So the question is, when do they really start getting some of that money back to dampen the bridge financing requirement in the meantime, right? I say capital because they're using what's called the ATM. I'll talk about that in a sec. But now, one thing you don't hear talked about a lot is, what is a $400 million loan, which is graciously extended to them at a rate near treasuries of the same term worth to a company like this? Well, EOS would never be able to scale at the rate planned without this money, or they'd have to dilute the living daylights out of shareholders, or take out extremely expensive financing, which wouldn't even really be possible. I mean, the interest would be so high. They couldn't do it through debt. They'd have to do it through equity or some other structured product. So I think people fail to appreciate the value of that commitment they have in hand, right? Provided they can deliver on their end of the agreement, which is, what's causing so much turmoil in the stock. And then, additionally, the DOE even selecting them and approving them, that provides a significant amount of reassurance that the technology is really as robust as we think it is, right? The DOE did a review of the technology themselves and came to the conclusion this is sort of a preferred company that they want to work with and lend money to. So the bridge financing is a major concern. EOS in true form has seemingly pushed out the timeline, which is slightly concerning, of course. Additionally, not quite as timely as the earnings release and whatnot. But Joe Mastrangelo, the CEO, he has bought about $150,000 between this and this in the last little while here. $150,000 worth, I should say, above $2. So, if we're buying at $1.15, we're buying at about half of his recent average cost. Maybe he has no clue what he's doing, but to me, he has a heck of a lot more knowledge about what's going on behind the scenes. And there's only one reason to buy your own stock. I mean, he thinks it's going higher, and he could be wrong, but it's encouraging at the very least. I think the retail community is very concerned about a number of things all of a sudden. One of which being a share consolidation, even because the share price is getting so low. So I don't know. Management is there with us to some degree, not in huge form, not the way that Innovix is. Their chairman in particular owns a huge amount of the stock. But anyway. And okay, why am I buying after the decline? Again, I have imperfect information on my side, to say the least. So, I believe the share price is sufficiently discounted here to compensate me for the risk associated with the risk of dilution going forward, right? It could be a lot of dilution, but if I liked this at $3 with an expectation of moderate dilution, and I did, right? I think it was a good risk reward there with the expectation of moderate or mild dilution, right? And so here we are at $1.15. I can afford to stomach a lot more dilution and have a similar outcome. So, they recently raised a lot of cash through what's called an ATM program, I should say, which is at the money equity program, which allows them to issue equity on a running basis, so essentially real-time diluting the shares. So, point being, I see dilution as a risk. If the share price gets stuck down here, it's a bigger risk. I do think, however, that this is an overreaction, and people are likely to see the risk reward as being very favorable here. If you had this opportunity 100 times, 100 different stocks with the same sort of situation, the outcomes are 0 or 10 or 15x. You take that trade over and over and over again, because from a probability point of view, that's a great outcome. So assuming it was 50-50 either way, and I don't think this is 50-50 either way, and I don't think 0 is a likely outcome. It's as I say, I think dilution is the concern, and I see a world in which they're doing $1 billion in revenue down the road, and they may have had to dilute the heck of the company, and I hope not. But if that's the case, it's still not a 0. It's just divided by however many shares they've issued, right? Or and the multiple that, of course, that $1 billion of revenue is trading at. Hopefully they'd traded a multiple of 2, let's say. So yeah, I guess my point is there is a type of buyer that should be very willing to come in here. And additionally, we've seen the worst elements at play in a decline. We have, short sellers continuing to pressure the stock. The short interest has not gone down. We have lots of retail participation, especially at the highs when there's the most excitement, which means a lot of weak hands, unfortunately, down here. A lot of retail's using leverage, margin. They can be forced sellers, and I bet today there were a lot of forced sellers because the stock's, down 25 and then another 15 at its lows today. Just, a huge amount of wealth destruction, if you will, which unfortunately causes margin calls. Personally, I was a buyer today. I tweeted it earlier. Bought at 115, like $1.15, 3,000 shares. I didn't buy in the funds, and we'll get into that, but I bought yesterday for the funds, thinking probably wasn't going to go much further, but here it is further. And I don't want to add additional exposure with the funds because they're not supposed to be. They're certainly not supposed to be a concentrated bet. They're diversified portfolios. Though EOS in the growth portfolio is a relatively concentrated bet. So again, we're hoping things will improve here, and I do have confidence. I'm not particularly concerned. So yeah, as I was saying, we have all the worst elements at play. We have the retail sellers getting potentially margin called. We have short sellers involved still. And we also have tax loss selling season on top of us. And then it's a confluence of factors in addition to the ATM being active, right? So it's just like sellers after sellers. So it doesn't surprise me in a way that it's as low as it is. It's sort of like, when there is no marginal buyer, what is the price, right? And we've sort of run out of buyers almost because there's too many sellers. So suffice to say, I'm happy to be a buyer, a holder down here. I have far less concern than the Twitter sphere at the moment. The other situation that resolves this to some degree is there's a few actually, and I won't go through all of them, but one of them is sort of the Carvana situation. Remember, this is, as I just said, heavily shorted, and Carvana was certainly heavily shorted. And I don't like Carvana, but what happened there was that it it was, going down, 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 and then it had a massive short squeeze, which just caused it to just get out of control to the upside. And Carvana, smartly basically managed to recapitalize the company, right? Like they had a pile of debt they were drowning in it, and they issued a bunch of equity, probably to the short sellers themselves who were getting squeezed at the top. And yeah, Carvana then, had the ability to pay down their debt and restructure the company going forward, and they could actually be a going concern going forward. So, if EOS had a bit of momentum, let's imagine the tables turn here a bit, and maybe shorts start covering, and some traders get involved. As something's picking up momentum, let's say EOS is going up 10% a day. I mean, it just draws in those sort of fast money types, and you could see the stock up quite a bit higher. And again, the ATM's active, so imagine that we get lucky and Joe and team are able to use the ATM at $3, $4, $5. That certainly minimizes the dilution. So, there's ways out of this. I'm not, as I say, I'm not as concerned as the Twitter sphere broadly at the moment. This was supposed to be a short comment on EOS. So let's move on to the portfolio and take a look at where things are sitting, because I think that's probably more interesting than the details. I won't go into Confluent because that was the other one I was going to talk about. But suffice to say, it's down a lot. It's recovering now. I think it's back up. We're up about 12 or 14% or something like that from our purchase. We bought. Did we buy after hours? Yeah, I think we bought after hours when it was down. Or no, we bought after hours, and then it went even further. That's right. But even so, I believe we're up, unless that's my personal portfolio. But you know what? I might have bought at the lows. Come to think of it. No, the speculative bought. The speculative bought after. I will look into this. Let's get to the bottom of this. Oh, right. Yeah. So we bought after hours at around 18. The day that the earnings came out, when it would drop significantly, down 33%, if I recall. And then it opened the next morning at 14. So I had made the trades for the portfolios at the after hours price. And then the next day I decided to actually buy some myself at 14. So hence why I'm up a little bit. But the funds will be up too, or the portfolios will be up as well. It's just I had slightly better timing just by chance on that. So okay, let's wrap this up with a quick portfolio recap. So this is November 8th, and the growth portfolio is up 4.6%. This is the no leverage, just straight growth. It benefited the most of any other than the levered, which is more or less the same, just from timing. It got in, a day or two earlier than the other two, which has certainly helped it, given that the timing was quite good. The levered portfolio is up 6 then, so the 4.6 to 6 is the same. Essentially, it's just the leverage is the major difference at this point. We haven't had to do any risk management, so everything's essentially the same, just 30% leverage. Over on the medium risk, we are, here it is, same thing. So number of winners in there and some losers, and so it's up 2.8% overall. Again, no leverage there. Has a fixed income component, which is actually doing quite well. It's 2.64%, which is indeed pretty good. That was TLH, the 10-year really having a nice day today, which is kind of odd because, bond yields are falling and the Russell was down, at 1.3%. So sort of opposite forces there today. Items of note, Smart ran up 38% now, which is pretty good. Unfortunately, I have a small position though. Fiverr up 15, 22 for Datadog, and it's backed off a little bit actually. Solar Edge, we're still up 15 because of our pretty good entry on that one. Novix up 23, Caribou up 24, Schrodinger up 15, HIMS up 17, and yeah, that's about it in terms of significant movers. On the upside, Camping World still down just because we had a terrible entry. Warby Parker down a little bit. And of course, EOS just causing havoc. But again, diversification, we're net up anyway over the last maybe less than a week on this one. Growth is now a good week. And then ironically, the low risk portfolio is doing really quite well, up 3.95% over the full time period, which is a whopping week, because it started at the same time as the growth portfolio. So that is indeed doing really well. Look at today's changes on these, like 1.7% for TLT. That's unreal for a single day. And then the medium risk, as I said, has some fixed income in it, so it benefits, minorly from that. And then the speculative, it started kind of at the worst possible time, 2 days ago, Monday of this week. So it's had some rough days, just based on its start. But it's actually still, it's not down much more than it was previously. And the reality is, it's down 13 grand overall, and EOS is 11,000 of that. So it's really just EOS that's causing problems here. Everything else is, net. We're basically flat other than that. So looking for EOS to recover, that will certainly help this portfolio, and then hopefully we get some traction with other things in the portfolio as well. I'll scroll through these slowly so we can see where we're at. There's still, some things we're waiting for pullbacks on that we may not end up buying anymore, because we're now up to 94% exposure. Actually, this should be included. I'll have to change that, but 95, call it percent. In fact, I haven't actually put the numbers in for Toast yet. That's why. Sorry, we marked it, but haven't actually done the math to add it. But anyway, we're getting closer to 100% exposure on the growth, and so we're aiming for 110, right? Ultimately, with a 30% from fixed income, creating the majority of our leverage, up to 140 on this one. So yeah, currently sitting at 125%, so 25% levered. Okay, that's probably enough of an update for now. Not much to report. Okay.
It's been fine this year, except my index shorts, which have been a disaster. But we always short the same way. I just try and look at the current situation, and then I try and think of a situation 12 to 18 months from now based on my forecast. And I think if I think the security prices are going to be less, then I short them. Frankly, I'm not sure I've ever made money. If I took back the last 40 years, I'm afraid to look. I've never had a down year, but I'm not sure I've made money in shorts. I like it. It's fun, but you can get your head handed to you. And it's a game that really only professionals, and the math's against you. If you're dead wrong on a long, you can lose 100%. If you're dead wrong on a short, you can lose 10 times your money. And when I was at Soros, I shorted $200 million worth of internet stocks in March of '99, and in 3 weeks covered them at a $600 million loss. I lost $600 million on a $200 million investment in 3 weeks. I was short 12 stocks. They all went bankrupt, every one of them.
Don't try that at home.
So